guys, welcome back to Tax Q&A. In today's video, I'll be answering all about tax on gifts. Let's get started. Anything that you receive for free or even at a price lower than what it's actually worth, that is what the tax department calls a gift. A gift could be number 1, monetary, which is straight up money, whether it's cash, check or bank transfer. 2, movable property. Think jewelry, shares, bonds, paintings, and yes, even crypto now falls in this bucket. Basically anything that you can move or trade. And 3, immovable property. That's your land, houses, flats, commercial spaces, mostly anything that is a real estate. So, first and foremost, if the total value of all the gifts that you receive in the financial year is up to Rs 50,000, it is tax-free. But if the value crosses 50,000, then the entire amount becomes taxable under the head income from other sources. For example, you receive 55,000 as gift in a year, the full 55,000, not just the extra 5,000, will be added to your taxable income and will be taxed at your applicable slab rate. Now, when it comes to movable property like jewelry, shares, paintings or even crypto, the taxable value is the fair market value of the asset on the date you receive it. For immovable property like land or buildings, if it's received without any payment, the stamp duty value is taxed. It's the person receiving the gift who is responsible for paying tax. So if you receive something that qualifies as a taxable gift, it gets added to your income and you are the one who is expected to pay tax on it. Gifting shares has actually become pretty common these days given how simple it is. As far as taxation is considered, when you receive shares as a gift, if the fair market value of those shares exceeds 50,000, you'll have to pay tax on it. Now this was when you received the shares. Another tax event occurs when you sell these shares. This is when you pay tax on the capital gains. To calculate the gains, you take both date and price of purchase as per the previous owner. So when you sell, if the holding period is more than 1 year, you pay long-term capital gains tax at 12.5%. If it's 1 year or less, it's short-term capital gains tax at 20%. Let's take an example to understand better. Say your friend gave you shares worth 60,000 rupees. Since the value is above 50k, the entire 60,000 gets added to your income and taxed. Now suppose your friend had originally bought those shares 3 years ago at 20,000 and you sell them 6 months later for 80,000. Here, your cost of acquisition becomes 20,000 and the holding period including your friend's time becomes 3.5 years. So your capital gain becomes 60,000, which is a long-term gain and hence taxed at 12.5%. Not really. So as we already discussed, if the total value of all the gifts that you receive in a financial year is below 50,000 rupees, there's no tax. Next, if the gifts are from close relatives, they are completely tax-free no matter the amount. But the Income Tax Act is pretty specific about who qualifies as a relative. This includes your parents, siblings, spouse, children, grandparents and some more people. Then there are some special occasions where gifts are fully exempt, like gifts received on occasion of your marriage or gift received through inheritance or under a will. Yes, in some cases, especially when the gifts are made within family. Clubbing of income applies in 3 cases, when you give something to your spouse, minor child or daughter-in-law. Let's say a husband gives money or shares to their spouse or minor child. Now because they are relatives, the gift itself isn't taxed. But if the gift starts earning income like interest, dividends or capital gains, that income is clubbed back with the husband's income and taxed in their hands. But if the income is from a gift to your major child or parents, then clubbing does not apply. They are taxed on that income in their own hands. If the gift is from a relative, then it does not matter whether they live next door or in New York. It is not taxable in India. So if your NRI sibling sends you money or even transfers shares or property as a gift, they'll qualify as a relative under the Income Tax Act and hence you're good, no tax. However, if they are distant relatives who aren't covered in the list, you will be taxed on the gift amount. If the total value of gifts from your employer in a financial year is up to 5,000 rupees, it is not taxable. However, if the gift value exceeds 5,000, then the entire amount is added to your salary and taxed at slab rate. Yes, you should. If the gift is taxable, you will need to report it under Schedule Other Source in your ITR. It gets added to your total income and taxed as per your slab rate. On the other hand, if the gift is exempt, you should report it in section Exempt Income. The amount will not be added to your taxable income. However, reporting it helps maintain transparency and avoid any questions from the tax department later on. And with that, it's a wrap. If Google search is too much work for you, Quora is full of opinions, then you should check out Tax Q&A, where you can toss questions and our tax experts give quality answers. And hey, don't forget to like and subscribe so you do not miss out on what's coming next. Catch you in the next one. Responsible बोला मैंने, responsible ही तो होता है, ज़्यादा ओ स्ट्रेस कर दिया मैंने। वही है, एकदम से मतलब मेरी ज़बान ही बंद हो जाती है for some reason, distract कर रहा है बैठे बैठे एकदम, ऐसा words आते आते आते, oh shit we don't have words anymore, sorry।